In America, dreams are borrowed. And for millions, they come with interest. For decades, student loans were sold as tickets to prosperity, a bridge from middle-class hopes to upper-class security. But by 2025, that bridge looks more like a trapdoor. 45 million Americans owe a combined $1.6 trillion in student loans. That's more than all U.S. credit card debt combined, and second only to mortgages. Roughly 1 in 6 adults carries student debt. The average balance? Around $37,000. But for graduate borrowers, it can top 6 figures. Welcome to FluxFolio Finance. Today, we're peeling back the curtain on the biggest financial burden no one voted for. How student debt became the quiet engine of inequality, and why Donald Trump's new loan repayment plan might reshape not just education, but the American economy itself. The making of a debt machine. Student loans began as a social promise, born from Lyndon B. Johnson's Great Society in 1965. The federal government wanted to democratize education, guaranteeing loans so every capable student could attend college. But by the 1990s, that promise had mutated into a trillion-dollar business. Today, about 92% of all student debt is owed directly to the U.S. Department of Education, not private banks. The government borrows cheaply from Treasury markets, then lends it to students at higher fixed rates. In other words, Washington is both the lender and the collector. Universities, freed from market pressure, raised tuition faster than inflation, 3 times faster since 1980. The average cost of college now exceeds $27,000 per year, including living expenses. Parents sign, students borrow, and Wall Street securitizes that debt into asset-backed bonds traded just like mortgages before 2008. It's an ecosystem built on the faith that tomorrow's salary will pay for yesterday's promise. A nation of borrowed futures. So how big is the problem? Let's compare scale. The U.S. economy is roughly $28 trillion in GDP. Student debt alone equals about 5.7% of that entire output. In the household credit market, it's about 10% of all consumer debt, larger than car loans, larger than credit cards. But what matters most isn't just the number, it's who carries it. Nearly 60% of the debt belongs to women. Black borrowers graduate with 13% more debt on average and owe more after 12 years than they initially borrowed due to interest compounding and wage inequality. The typical borrower takes 20 years to pay off a bachelor's degree, and many never do. The result? A generation that delays buying homes, starting businesses, or having children. In 2025, the home ownership rate among borrowers under 35 is at a 40-year low. Student loans are not just personal burdens, they are macroeconomic brakes. Trump's big education reset, enter the One Big Beautiful Bill Act, signed into law in July 2025. A sweeping reform that, depending on whom you ask, either simplifies chaos or cements control. Starting July 1, 2026, new borrowers will have only 2 repayment options: a standard plan with fixed monthly payments and a new repayment assistance plan, RAPE, based on income. Sounds fair, but the details tell a different story. Existing income-driven plans, like PAYE, SAVE, and ICR, are being phased out. For future students, monthly payments could last up to 30 years before forgiveness. And the most generous features of past programs, early forgiveness, interest subsidies, are gone. Graduate school loans will face caps of roughly $100,000. Parent Plus loans, $65,000. For many middle-class families, that means fewer federal options and a forced turn toward high-interest private lenders. Trump calls it responsible borrowing. Critics call it a stealth austerity, one that makes college accessible to fewer, not more. Fiscal discipline or fiscal desperation? On paper, the new law reduces government exposure to bad debt. But behind the curtain, it reveals something deeper: Washington's hunger for liquidity. By 2025, the federal government is juggling $7 trillion in debt maturities and an annual interest bill exceeding $1.1 trillion. The Treasury needs buyers fast. So trimming loan forgiveness and limiting federal lending isn't just about moral hazard. It's about cash flow. Every dollar not lent to a student is a dollar that stays available for bond auctions, for defense contracts, for a swelling deficit that already hovers near 6% of GDP. Some insiders whisper that the education cuts are the fiscal mirror of Trump's 100-year bond proposal, a way to stretch obligations far into the future while preserving near-term liquidity. The student loan system, in that sense, becomes a microcosm of America itself, leveraged, aging, and addicted to debt. The inequality engine. Here's where the gap widens. When tuition rises and lending tightens, the rich pay cash, the poor borrow or drop out. Lower-income families, already short on generational wealth, shoulder debt that eats decades of earnings. Wealthier graduates, free of that drag, invest sooner into homes, stocks, startups. Their capital compounds. Debt, meanwhile, compounds in reverse. Studies show that every extra $10,000 in student loans reduces the probability of home ownership by 4 percentage points and delays median net worth attainment by over 20 years. Black and Hispanic borrowers default at nearly double the rate of white borrowers, partly because of labor market discrimination and family wealth gaps. Women, who hold the majority of student debt, earn roughly 83 cents per male dollar, magnifying the payback struggle. The result is what economists call the education paradox. The very system meant to equalize opportunity now amplifies inequality. Social consequences. Debt doesn't just change bank accounts, changes behavior. Borrowers delay marriage, skip healthcare, and take fewer entrepreneurial risks. Surveys show 60% of graduates in their 30s say debt influences major life decisions. And politically, it fuels polarization, one side demanding forgiveness, the other demanding accountability. Universities, too, face moral hazard. If borrowing gets harder, enrollment drops, especially among minorities and rural populations. That risks a shrinking educated workforce, just as the US confronts demographic aging similar to China's. A society that discourages learning discourages growth. And a country that monetizes education risks monetizing its future. The macro ripple. Let's connect this to the broader economy. Student loans feed directly into the Treasury market. When the Department of Education issues loans, it borrows from Treasury accounts, effectively recycling government debt. When repayments slow or forgiveness expands, the Treasury must borrow more elsewhere. It's a hidden fiscal loop few notice but every taxpayer funds. By cutting back lending, Trump's team aims to shrink that loop. Yet the short-term effect may be contractionary: fewer loans, less tuition revenue, university layoffs, less consumption. In a $28 trillion economy, that may seem small, but education and related industries account for nearly 7% of US GDP. Pull one thread and you tug the entire fabric. Investors already sense the tremor. Credit rating agencies, still jittery after Moody's AA1 downgrade, warn that restricting educational access could curb long-term productivity and weaken human capital growth, the very asset that sustains America's creditworthiness. The political narrative: Trump frames the reform as fiscal realism, ending what he calls loan socialism. But critics argue it's about optics, appearing tough on debt while shifting burdens downward. The irony: the same administration proposing 100-year bonds to expand federal borrowing is cutting back the smallest borrowers, students. It's a tale of two debts, one institutional, one individual. One forgiven through financial engineering, the other enforced through payroll deductions. In the long run, this divergence could become the defining moral line of a new economic order, where capital debt is negotiable, but human debt is not. The global lens. Across the world, countries wrestle with similar challenges. In the UK, student debt exceeds £200 billion. In China, youth unemployment soars while tuition remains state-subsidized. America's model stands apart: privatized risk, public profit. Foreign observers see this as both strength and weakness. It builds financial discipline, but at the cost of generational trust. In a global race for innovation, the US cannot afford to turn education into an elite commodity. Because every student who drops out under debt pressure is not just a lost taxpayer, they're a lost engineer, nurse, coder, teacher, the invisible workforce of tomorrow's economy. Student loans once symbolized hope. Now they symbolize hesitation. The average borrower in 2025 is 38 years old. Many are still paying for a degree they earned during Obama's first term. Some will retire before their debt does. Trump's new policy might simplify repayment, but it doesn't solve the equation. It makes education safer for lenders, not for learners. And so America stands at a quiet crossroads. Do we finance the future through opportunity or through obligation? The next decade will decide whether student loans remain a tool for mobility or a mechanism of control. Because a nation that mortgages its youth mortgages its destiny. If this deep dive opened your eyes, share it. If you've felt the weight of student debt, tell your story in the comments. And if you want more narratives at the crossroads of money, policy, and power, subscribe to FluxFolio Finance. Until next time, stay sharp, stay thoughtful, stay ahead.